Welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. It's my pleasure to welcome the CEO of Value Research, Dhirendra Kumar. Dhirendra, welcome.
Thank you.
More often than not, all the investments are aimed towards retirement. And this is a very, very important plan that we all have to undertake in our lives. All moves are based or directed at retirement. So how much money is important to have a comfortable retirement? How do we figure that out?
I really don't have an answer because, it's a very subjective thing. It entirely depends on your context. It depends on your circumstances. It depends on your number of dependents when you retire, your state of health, the amount of assets that you have already accumulated. Think of a person retiring. If he has a house or if he doesn't have a house. So, that will actually alter
a lot of
factors. Yeah. But I would say that, if one has to do some kind of estimation, then your current income need, assuming that you need 30,000 rupees to live comfortably, or you need 1.5 lakh rupees to live comfortably, which means, assuming, for ease of calculation, assuming that you need 12 lakh rupees a year to live comfortably, a lakh of rupees a month, which means you need 12 lakh rupees post-tax. After paying taxes, you should have. So now you work backward. Do you have a pension? Do you have a rental income? So remaining money should be supported by return from investment. That should be your retirement corpus. Assuming that you need this whole 12 lakh rupees from your investment and you have nothing else. You have no rental income, you have no pension. Then in that case, this 12 lakh rupees, if it is going to be 4%, your capital should be this 12 lakh rupees should be 4% of your capital. That will ensure, so one can work on a financial plan that you will be living independently. Because ideal retirement plan with investment should be something that you have a 4% withdrawal rate, which will ensure in the initial years, and which will ensure that you can increase your earnings because your capital also needs to grow. Because 1 lakh rupees a month you need today, next year you just might need little more than 1 lakh rupees. 5 years from now, you just might need 1,15,000 rupees with rising inflation. So the investment should be such, and a 4% to 5% withdrawal rate will ensure that you can you can work on an investment plan which can support rising income requirement in your retirement.
So Dhiren, is there a magic figure that fits all? How do we calculate that?
As I said, that there is no magic figure. You have to really worry about your conditions, your circumstances. But doing a realistic assessment, one thing is that you have to take into account the changed circumstances. Look at your annual expenses or monthly expenses multiplied by 12 plus additional extra expenses that happens not so often. So I would say that assuming a 5% withdrawal rate, whatever be your annual requirement, you should have 20 times that money. Assuming that you need 10 lakh rupees in a year, then you need 2 crore rupee. Because 2 crore rupee will be able to support the need for 10 lakh rupees now, which needs to be adjusted or revised upward for inflation. And having this 5% withdrawal rate, it looks, reasonable. So, and it is important that you err on the side of caution. The reason why I'm actually making it more conservative, I'm putting a larger number, 5%, and is that we are going to live longer. Medical expenses will balloon, which has not been anticipated, and it's very difficult to estimate that when you are young because you don't face those issues. So living longer and health cost is going to be a very significant change in your retirement, and that too in the late stage of your retirement. So working towards that, having this, extra preparation and a conservative withdrawal plan of 5% will ensure that because you have to ensure that you are running a plan where you don't run the risk of outliving your savings. That could be a nightmare. And because people are going to live longer, that is going to be a possibility. So while I'm giving this plan whereby we are assuming that all the capital will still be there for your heirs. So it's not that you need 2 crore rupee for having that 10 lakh rupees a year. If you actually consume a part of your capital, but consume a very small part of your capital over a long period of time, it's fine. But just to be cautious, this is the ultra conservative plan which people should have in their retirement.
Okay, and what is the best way? In what, where rather, I should ask, where should we invest this kind of money so that we get this kind of return?
People always look for the formula, or look for a specific vehicle, or look for a plan which will take care of everything. And because everybody thinks that, there has to be some plan which will take care of it conclusively. And NPS in a moderate way is trying to achieve that. But I think it's very important to understand conceptually what it is. You have a long phase of accumulation because you work for 20-30 years after you get into, after you become independent financially. And those 20-30 years, the power of compounding, for it to work, you have to be regular, you have to be increasing, and you have to be disciplined of not taking that money out. So this is your accumulation phase. And in the accumulation phase, be into equity as much as possible. The maximum that you can have in NPS is 75%. With your equity fund, you can well be 100% in the first 10, 15, 20 years. And then have your rebalancing allocation of 10, 25% or whatever till you retire. So if you don't work on your accumulation phase, your retirement is doomed because you can't retire. You have to look at the prospect of working forever, which is not possible. So this particular accumulation phase, if you have these 2-3 things, investing in equity, investing regularly, that is your accumulation phase, and being disciplined about it, not consuming that money. And once you get into the consumption phase, once you get into the income phase, being conservative about it, conservative about the withdrawal, as I was saying that 5% is a fairly conservative thing. Still being in equity, your investment must perform in retirement as well. Because if you invest all of it in fixed deposits, it will be taxable, it will barely match inflation, and it will not grow. And it is important. Yeah. So it is important for your money to be growing moderately or reasonably, even in retirement, because that is also long phase. That could well last for 20 years, 30 years, which wasn't the case earlier. And so accumulation phase, work hard. Deaccumulation phase, work conservatively and be disciplined.
Okay.
And you can have your retirement plan any way you want to.
Okay. So income generation plan phase is extremely important, just as the accumulation.
Yeah, if you don't have it, then you really won't have anything to support it.
To support yourself. Okay. How should one use the accumulated corpus in the post-retirement years? In the first 4 to 5 years before the retirement, should I do something, or how do I divide the years?
Not necessarily, but just to be a little more cautious, 2-3 years before you retire, start preparing with a fixed income allocation so that your 2-3 years annual income requirement can be had from fixed income. That is one way of looking at it. Assuming that your monthly need is 50,000 rupee and you have accumulated sizable money for accumulation for your retirement. So make sure that you have 18 lakh rupees worth of fixed income investment, fixed income fund investment, which you can start, so next 3 years post retirement, you don't have to worry about income. The rest of the money can still be long term. And then I would say that if you have margin, if you have been able to build a meaningful margin, then having a very simple plan, having 50% into equity through a fund, 50% fixed income through funds, and an annual rebalancing can also take care of it. Or to keep it even simpler but a little more aggressive with simplicity, could be a balanced fund. Even a balanced fund can support, or more conservatively, an equity income fund can support a more conservative plan. Here you don't have to worry about the rebalancing yourself. The fund will be rebalancing automatically. You just have to invest, make sure that those investments. So pre-retirement, you have to prepare for 2 things. One is change your equity investments into one of these allocations, either a balanced fund or a 50-50 equity debt or a more conservative one. and prepare with 2-3 years of income requirement entirely into fixed income. These two things, and an annual rebalancing if you are doing your equity and debt investments yourself, you have your retirement taken care of.
Okay. Sounds good.
It
sounds
simple.
Easy.
Yeah.
Simple.
But
what is important, Dhiren, is for the accumulation phase. You have to get into investments now.
Yeah, you have to start.
If you don't have, as you very rightly
early.
said, you will have no income generation phase then.
You will not have accumulation to support your income, and you have to be extremely careful about it, because what happens is because of the liquidity, a lot of investors get tempted that next plus the LCD TV, the World Cup is coming, so resist some of those things, because this is a part of money, part of your financial allocation, which should not be disturbed at all. You have to think in terms of very, very long period and be extremely disciplined about it. Resist your temptation. Of course, extreme emergency, it's your money, use it. But resist your tempting spending traits to disturb this money.
Okay. So especially the youngsters who are watching us, make sure you start investing now.
Yes,
extremely
absolutely
important. We have questions now from our viewers, and the first one is from Anshul, who says, I'm close to 50 years of age and have not been able to save anything significant for my retirement. I don't plan to retire at the age of 60 and would be hopefully working till 65 or 70 years. But how should I start for it now?
Start now is the first thing, because if you have not with that, starting trouble itself is a big problem. And then whatever you can save, be into equity, be into a multi-cap fund, and be very aggressive about it, and make sure that you are not touching that money. 10-15 years is a good enough period which can actually support income for another 10-15 year period. But maybe, Anshul, you should consider that if you have not been able to save and if you have not been able to invest, maybe you have been able to build some other asset. Assets are fungible. If you have 3 houses and no investment, some houses can go away to actually support your investment or some other thing. Unless, you have all your savings and investment which has been consumed, and it's not an unusual situation in a growing family where kids' education is to be taken care of, or household has to be run, and initial phase of your career, and you don't have old parents to be taken care of. There could be circumstances where people are unable to save for a very long period of time. But as you are asking this question, make sure tomorrow morning you have your investment account open. You start with your SIP. Try and save as much as possible and invest all of it. And don't turn back to look at them for at least 10 years.
That's a starting point, Anshul. And moving on, Kritika says, I've come across some retirement-specific mutual fund schemes. Should I invest in them for my retirement?
No, any investment which you are disciplined about, that you will not touch it till your retirement, is your retirement fund. Okay. And all the pre-packaged retirement plans, they come with some constraint. They come with some constraint in terms of allocation or ceiling on allocation. Even the NPS, the maximum you can invest in equity, could be 75%. For somebody who's 25, 28 year old, I would like him to be fully into equity and entirely. And if you are able to save only 1.5 lakh rupees a year, invest in a tax saving fund, get the 80C break, and keep doing it. That is your retirement plan. If that is the only money which you can invest, even a 30-year plan to invest in ELSS can be your retirement corpus, and it could be a very sizable one.
Hiren Narayanan writes, my mother will be getting around 1.15 lakhs as the maturity proceeds from an LIC policy. She wants to invest it for 5 years. Where should she invest?
1,15,000 to be invested for 15 years for your mom, which she does not require the money for another 5 years. Start conservatively. Invest in the growth plan of an equity income fund. That will get you more return than a fixed deposit. Maybe 5-year full market cycle, it could be meaningfully higher than what you get in a fixed deposit.
Atukuri writes, what is the difference between trailing and rolling returns? Which one among the both should be considered while choosing a fund?
Trailing return are dependent on a point of time. So trailing return, 3-year trailing return means the NAV today, the NAV 3 years ago, the difference between it, annualized, and that is trailing return. It is dependent on 2 price point.
Okay.
Rolling return
is the average.
Rolling return is average. So, assuming that a 1-year return today, assuming that a NAV is 12 rupee and a year ago it was 10 rupee, trailing return is 20%. The rolling return will be going back 2 years. Every day you calculate 1-year return over the last 1 year and average it. And that is the rolling return. So rolling return is more robust. That is more likely. That is a greater probability. It is reflection of, because trailing return is dependent on being lucky. You invested on one day and took the money out another day, a year from now or 3 years from now. That is trailing return. If you would have invested on any of the days in those years, that year, and held it for 1 year, what is the likelihood or what is the probability of getting that return? Average of that is rolling return. So rolling return is a superior reflection of the likelihood, but none of it is likelihood. Past is history, and mutual funds are subject, past performance cannot be banked upon. But yes, to comparison, if you have to, rely more on one, it will be rolling return.
Gopal Krishnamurthy writes, what are exchange traded funds? How are they different from mutual funds?
Exchange traded funds are, exchange traded funds. They trade on the stock exchange, unlike the mutual fund, which is, so they are traded on the exchange. Normally, ETFs are mounted on index. So you have the Nifty ETF, you have the Sensex ETF, or you have the Gold ETF. So the investment is predefined, the ratios are defined, and then you buy it. The difference between a mutual fund and comparing an index fund, which you buy as an open-end index fund as compared to an ETF, is that to buy an ETF, you go to a stockbroker. To buy a mutual fund, you go to the fund company or you go to a mutual fund agent or, some other direct intermediary, direct as well. So, and the mutual fund is bought at that day's NAV. There is a fixed price. So when you invest 50,000 rupees today, you don't know what the price is. And in the evening, whatever be the price, whatever be the NAV, your money will be divided by that and you will be allotted those units. When it comes to buying an ETF, you go to a broker, you place the order and he buys that unit for you, those exchange traded unit. The price can vary. It can vary from NAV because depending on the demand supply, it could be plus minus the NAV. The broker will also charge his brokerage and it will be lying in your demat account. So these are the two formats, index fund as compared to an ETF. So, and there could be multiple prices for ETF. Every day through the day, there will be many buyers and sellers, and depending on what prices they are able, the price at which they are able to strike a deal is the price, your purchase price, unlike the fixed price at the end of the day in case of a index fund.
Okay. Should we give importance to the AUM size while choosing a mid or small cap fund? Asks Vidya Sagar. And what should be the threshold?
Yes, it's important. I have, mid and small cap funds struggle when they turn big. And I would say that any small cap fund which is more than 3,000 crore will have to find way too many ideas to succeed. Likewise, in case of mid caps, because the mid cap universe, now SEBI has gone about devising the threshold. So mid caps are top 100 companies beyond top 100 companies are mid caps. So I would say that 10,000 crore and bigger mid caps will face will face winner's curse.
Okay. Okay. Nirmal says, I have a horizon of 10 to 15 years. Should I invest in an index fund or go for a mid cap fund?
Here I would say neither. I still feel that, investing for 10 to 15 years, more than a mid cap, go for a multi cap and not an index. I'll tell you the reason. Mid caps can crumble and that can shake you and drive you out of the market. And for index fund, I think, index funds, we don't have too many avenues. If we had a multi cap index fund, there might still be case, but most of our index funds are actually large cap funds. And 2018, most index funds did very well, much better than most of the actively managed fund. But 2018, I would say, was an outlier. It was an exceptional year. 3 stocks in the index did exceptionally well to boost the performance of index, which looks like they have been able to build a case. But I still have the opinion that in India, indexing is yet some time away from being very popular or making a strong case for itself. In a full market cycle, multi-cap funds will do better. So start with a multi-cap fund and stick to it for next 10-15 years. In between, we will revisit this. Maybe multi-cap funds, they lose their case, or index funds are able to build their case far more strongly. One can change the tactic. But important is to be in equity and avoid extremes and be actively managed.
Okay. Lakshmikant Wise, I'm a central government employee and I have a CGHS policy for medical purpose. It requires me to pay only 1% of my salary, irrespective of the benefits from the departmental hospitals. Do I still need to buy a health insurance from a private insurer separately? I'm 45 years of age.
Depends. Try out your CGHS facility. CGHS actually gets you 2 things. One is that critical illness and hospitalization expenses in many of the good hospitals also is enabled. But depends that in the city in which you live in, what are the kind of CGHS enablement? It is very good in Delhi. I find that in Delhi, because there are many central government employees are concentrated here. But so the facilities available are or the enablement from CGHS is very meaningful. It may not be in smaller cities where the density of retired central government employees or central government employees will be less. So that's one. So evaluate it yourself. I think CGHS takes care of it, and then maybe have a small supplementary health insurance. Because in case of a certain emergency, if you have a small coverage of 2-3 lakh rupees, so you hospitalization and other things, but it entirely depends on your own estimation of your health conditions or your dependents, and maybe a 5 lakh rupees family floater, which will not cost very much, might be a reasonable umbrella.
Thank you, Dhiren, for answering all the questions of our viewers. And would I be right in saying, for us to take care of our future, we need to start investing in the present?
You should have done it yesterday, else you have to do it right now.
So that's the lesson for today. Please start investing now for a better future. Till we meet next time, it's bye from Dhirendra and me, Rajesh.